subject of this webinar is a discussion of IRA trusts. My name is Ann O'Hara, and I'm principal of the Law Office of Ann M. O'Hara, PC. Our goal today is to take a look at what are the requirements and what are the pitfalls if we name a trust as a beneficiary of an IRA. As we'll discuss later in this webinar, is that there are specific requirements under the Internal Revenue Code as to who can be what is called a designated beneficiary. But first, let's look at what is an IRA. An IRA, which we know is an acronym, it is the Individual Retirement Account, or IRA, as we said. What is that? That's an investment account established by an individual. Assets can appreciate on a tax-deferred basis. Two types of IRAs. You have traditional IRAs and also Roth IRAs. For traditional IRA, the maximum contribution for 2019 is $6,000. Contributions can be tax deductible, but that's going to depend, and maybe that deduction may be limited or not allowed due to qualified retirement plan, taxpayer's income. And when we say qualified retirement plan, this restriction would be if I am an individual and I do have an IRA, but I'm also covered under my employer's qualified plan, then my deduction to my individual IRA may be limited. And when we talk about a qualified plan, what we're saying is an employer would have, typically you hear the term a 401k plan, a tax-deferred plan for private employers, or perhaps a 403b plan if my employer is a government or tax-exempt entity. Generally, a taxpayer has to have earned income to contribute to an IRA. Roth IRAs or contributions are made with after-tax dollars. Contributions are not deductible. One of the goals or the purposes of a Roth IRA is keep in mind, unlike a traditional IRA, because the account owner is contributing after-tax dollars, so taxes have been paid, essentially we'll review that, is generally what we're saying is with a Roth IRA, why would we do that, is that the benefit is going to be the appreciation on those dollars on the after-tax dollars. As a result, because they are after-tax dollars, an IRA owner can withdraw contributions at any time without triggering income tax or penalties, the early withdrawal penalties. Earnings, remember that appreciation can be withdrawn and not subject to income tax and penalties if IRA owner owned the Roth IRA for 5 years and IRA owner is at least age 59 and a half. So many times in a plan, you'll see an individual have both a traditional Roth IRA because we want to use the after-tax dollars to get the benefit of being able to withdraw the appreciation, the earnings. But then again, you may also have a traditional IRA as a companion so that those assets will appreciate on a tax-deferred basis. So what happens upon the death of an IRA? And this is true for both a traditional and Roth IRA. It's paid to the designated beneficiary. As we will discuss later in this webinar, that's a defined term, and that's an important term to understand. Because if there's no designated beneficiary, the IRA must be distributed by the end of the 5th calendar year after the owner's death. What that means is, and just kind of walk through that, is if I have an IRA and I don't fill out the designated beneficiary form, then typically what will happen per the account contract is that that's going to be payable to my probate estate. Probate estate is that entity that's created when someone dies and their assets need to be transferred to their heirs. In the event of that, what that means is that the estate is going to have to receive all of those tax-deferred dollars, and those distributions have to be made by the end of the 5th calendar year after my date of death. And while there's some income tax planning, keep in mind the estate will then recognize and pay income tax on those IRA proceeds. Or additionally, if the estate distributes those IRA proceeds to the decedent's heirs, then the respective individual beneficiaries of the estate will again have to recognize that as income. Versus, as we'll review, versus if there's a designated beneficiary, the designated beneficiary has the option to roll it over and can continue the tax-deferred status. So that's where the designated beneficiary piece becomes very important. Because if I have a designated beneficiary, that then a designated beneficiary or beneficiaries can continue to the tax-deferred status of the IRA. If I don't have a designated beneficiary, that's not an option. It's going to be immediately recognized as taxable income and subject to federal income tax. So who's the designated beneficiary? Designated beneficiary can be an individual, group of individuals, or qualifying trust. Important to note, a charity, a corporation, a partnership, a business entity, an estate, as we discussed, or a non-qualified trust cannot be a designated beneficiary. So generally speaking, in order to get the continued tax-deferred basis, tax-deferred treatment, then it has to be individual or individuals or qualifying trust. Because in some situations, many individuals have their wealth accumulated in their IRAs. Perhaps they have a family member that, while they certainly want that family member to benefit from that asset upon their death, perhaps they feel that family member is not perhaps able to manage those assets. And maybe you don't have confidence that individual would, in fact, roll that asset over, the IRA over, and continue the tax-deferred status. So the idea is, well, gosh, is there a way perhaps we could put it in a trust for the benefit of that individual and still have that qualified as a designated beneficiary? So let's look at what these rules are, and again, keep in mind, the point being here is we want to use a trust as the beneficiary of this IRA, but we're wanting to make sure that the trust has the ability to continue to the tax deferral treatment of the IRA. Here's an illustration of what can go wrong. This is Private Letter Ruling 2011-17042. So a disabled individual transferred the balance of his IRA to a separate trust held for the individual's benefit. Trust was intended to qualify for special needs trust under the individual state law. So essentially what this individual has done is there is a separate entity, a separate trust has been created, and the individual is actually, per the private letter ruling, the individual directs the custodian account to actually transfer title of that IRA from him individually to the account owner's name individually to the trust for his benefit. The IRS found that the individual had to report the entire balance of his IRA and the tax year that the IRA was distributed to the trust, since an IRA cannot be set up in the name of the trust. To follow up on that, what that means is the individual has to remain an account owner. Any transfer of the title of the IRA during lifetime to the trust is going to be a taxable event. So again, keep in mind, and the reason I bring this to your attention is it's very important, again, for the tax deferral to continue, is the account owner still must be titled and own that. And then, as we'll discuss, upon that account owner's death, that's where the designated beneficiary becomes key. One of the other things, as we're going to review as far as the qualifying trust, is we also need to keep in mind the required minimum distribution rules. At death, a participant's retirement benefits, which is IRAs and qualified retirement dollars, can be distributed gradually through annual distributions over the life expectancy of the participant's designated beneficiary, or by any more rapid means of distribution. So to review, we know that when we have an individual as a designated beneficiary of an IRA, that designated beneficiary can roll over that account, sometimes depending on the situation, either the designated beneficiary's name, or alternatively, it's an IRA that's considered inherited. But that can be rolled over, continuing the tax-deferred treatment. Here, for our purposes, keep in mind that one of the other options would be is those IRA retirement dollars can be paid over time over the participant's designated beneficiary. So this would be another option, alternatively, to a rollover. So, in order for that stretch out, in order for those annual installment payments to be paid over the life expectancy of a trust beneficiary, that trust must be qualified as a conduit trust. And a conduit trust is what it means. And keep in mind what we're saying. It's a conduit trust. Income is coming in, income is coming out. It serves as a conduit. Typically, you're going to see language in there where principal distributions can be made to the trust beneficiary at the trustee's discretion, subject to set standards. But when we talk about conduit for purposes of a designated beneficiary, what we're saying is income's coming into the trust, income is coming out. So a conduit trust permits required minimum distributions to be paid in annual installments over the life expectancy of the oldest beneficiary of the trust. So what we're saying is, keep in mind, conduit trust, income comes in, income comes out. So the required minimum distributions based on that trust beneficiary's lifetime, and understand that in the IRA, when these dollars are coming out, that's income. And the calculation of that, again, based on the trust beneficiary's life expectancy. So those dollars are coming into the trust, and in turn, because it's a conduit trust, those IRA dollars are going out to that individual beneficiary. One of the things with conduit trust is that we talk about where we have multiple beneficiaries. What we're looking at is we're looking at the life expectancy of the oldest beneficiary of the trust. So if we have 3 children and we have one trust of which those 3 children are beneficiaries, then in terms of calculating this distribution from the IRA to the trust, we're going to look at the oldest child's life expectancy to determine that annual amount that will come out and be a conduit and paid through the trust. So what's the requirements of a conduit trust? A conduit trust must meet specific requirements, and it must meet these 4 requirements on or before October 31st of the year following the year of the participant's death. So it's not just enough to have the language in the trust agreement, but there are additional steps. Number 1, the trust must be valid under local law. The trust must have identifiable beneficiaries, which can include class beneficiaries such as my descendants. Trust must be irrevocable on or before the participant's death, and the plan administrator must be provided with one of the following: copy of the trust instrument, a list of all the trust beneficiaries, including contingent and remainder beneficiaries determined as of September 30th of the year following the year of the participant's death. So, for example, I create a revocable trust today. Within that revocable trust, state that upon my death, I'm going to create a trust for my beneficiaries, even though the trust today that I signed today is revocable, but once I die, that trust becomes irrevocable. That will meet these qualifications. Let's also review, and I want to go back through when we look at the list of all trust beneficiaries, including contingent and remainder beneficiaries. Keep in mind, let's go back. If we're a conduit trust and we meet these requirements, the value of that is that the IRA, the tax-deferred dollars, that required minimum distribution is going to be able to be paid over annual installments of the oldest beneficiary. As we will get into later in the webinar, there could be an issue with regards to contingent beneficiaries. Also to point out, for example, we have additional language, the beneficiaries is determined as of September 30th of the year following the year of the participant's death. That becomes significant because if what I've done, I've created my revocable trust, I provide upon my death, there will be a trust for my beneficiaries. On my IRA, I have, through the designated beneficiary form, have said I've designated $10,000 of my IRA will go to charity. The balance of that will go to the trust for my beneficiaries under my revocable trust. I die. Because there is a non-designated beneficiary, i.e. the charity, as a beneficiary, then what the rules would provide, that there's no designated beneficiary for the entire IRA trust. So what that means is that in order for my trust and my trust beneficiaries and their life expectancy to be used, what we have to do is make sure that that charitable bequest from my IRA gets paid out no later than September 30th of the year following the year of the participant's death. So what the IRS is saying is, we'll let you, when that individual dies, for those entities or those beneficiaries who would not qualify as designated beneficiary, you can pay those out, and as long as you do it in a timely fashion, then we will allow the continued designated beneficiary status for the trust beneficiaries. Now let's look at an accumulation trust. This is in contrast to the conduit trust. The trustee of accumulation trust is sole discretion as to when and how much the trust estate shall be distributed to the individual beneficiaries. It's not required to automatically distribute to the trust beneficiary the IRA's minimum required distributions. So to put it in contrast, conduit is, that is a trust, it is what it is. In other words, income's coming in, income's coming out. With accumulation trust, what we're saying is, trustee, you decide income, principal, whatever is to be distributed. Trustee, you're not required to distribute income. You're not required to distribute required minimum distributions. For personal reasons, that may be the appropriate tool. And you want the trustee to have full control and determine what is appropriate. And that may make perfect sense. But here's what could happen as far as what that looks like as it relates to an IRA with tax-deferred dollars. In an accumulation trust, all potential trust beneficiaries of accumulation trust must be considered in calculating the minimum required distributions. Although a contingent beneficiary, which is a mere potential successor, does not have to be considered. But keep in mind, we're trying to think about, we want the annual installments to come out of the IRA. We want to do that in the most tax-effective manner. We're looking at which life expectancy do we use. Well, if we have an accumulation trust, now we have to consider all potential trust beneficiaries. Conduit, the advantages, the IRS has issued regulations setting out specific requirements to ensure the life expectancy of the older trust beneficiary will be used to determine the required minimum distributions. In other words, it's clear this is how the IRS says, if that's your intention, that you want to use that life expectancy and do those distributions in annual installments, this is how you do it. The disadvantage is, it is what it is. The distributions must be made to the trust beneficiary or beneficiaries on an annual basis. So those dollars need to come out, and they can't be held within the trust, or rather maintained within the IRA. The accumulation is the trustee is not required to make annual distributions of the required minimum distribution to trust beneficiaries. The advantage with the accumulation is, I don't want this particular individual. If I'm the account owner, I'm like, gosh, I really don't want that individual to get those dollars out, outright. I want that to continue to be invested. The problem is that may become an issue in terms of what life expectancy is to be used to figure out the required minimum distributions, and so that becomes how do we have an accumulation trust still qualify as a designated beneficiary? So we're still looking for the IRS for some direction on that. And the issue being, again, what we're trying to look at, and the goal of this is, we have tax-deferred dollars in this IRA account. We don't want to have all of those dollars be subject to income tax. We also want those dollars to, hopefully, we want to make sure those are spread out in a tax-effective manner. So here's an example of an accumulation trust and the tax consequences. Grandmother designated trust as a beneficiary over 4 IRAs upon her death. Grandmother died in 1999. The primary beneficiaries of the trust were grandmother's 2 minor grandchildren. The trust was accumulation trust. Trustee had discretion to pay trust funds to the grandchildren for their support, health, and maintenance. At age 30, each beneficiary could withdraw his or her entire share, each grandchild. If the beneficiary died before the age of 30, the trust was to be distributed to contingent beneficiaries. As of December 31st of the year following the grandmother's date of death, the oldest, and keep in mind, that's when we're calculating the required minimum distributions, the oldest contingent beneficiary named in the trust was 67. Think about in terms of if I have a grandchild who's under the age of 30, when we look at life expectancies, that's going to be a longer payout stream. That's not going to be the case if we have someone who's age 67. That's obviously going to be a shorter payout stream. The trust did treat the individual trust beneficiaries as designated beneficiaries. So it was going to allow that the trust will pay out, and the IRA would not have to be determined to not have a designated beneficiary and become taxable subject to the 5-year rule. But the IRS found the distributions to the trust, as I said, the IRS found the distributions to the trust did qualify for the exception to the 5-year rule. And that's, again, just to review, why does this become important is if I have an IRA that has no designated beneficiary, that IRA has to be paid out within that 5-year period. So it's going to be subject to income tax. And again, part of that is if you have a sizable amount of your assets in that IRA, bottom line, that's going to become essentially immediately taxable. Versus if I have a designated beneficiary, there are some options how that will get paid out over time, so it will not trigger immediate taxation. What is important in this is that the IRS said, yes, we have identified beneficiaries. All the other 4 steps have been completed. So we'll recognize the accumulation trust as a designated beneficiary, and you don't have to pay it out over 5 years, but here's what happens. Because of its accumulation trust, the IRS found the trust had the ability to accumulate distributions to the IRA accounts. IRS held that the contingent beneficiary's life expectancies must be considered in determining the beneficiary with the shortest life expectancy. Remember, it has to be with rapid amounts. The oldest contingent beneficiary was 67. Therefore, the IRS required that the 67-year-old life expectancy be used in calculating the minimum required distributions rather than the grandchildren's life expectancies. So, in summary, what we're saying is that where we have a conduit trust, it's clear when we have the required minimum distributions are required to be paid out on an annual basis to the beneficiaries, then we know in calculating the required minimum distributions for the IRA, we use the oldest beneficiary, trust beneficiary, that life expectancy. However, for an accumulation trust, now we're looking at we have to acquire the oldest life expectancy to calculate those minimum required distributions. So that's going to come out rapidly, more rapidly than if it's a conduit trust. And the reason why we're using the 67-year-old life expectancy, again, the trustee had the ability to hold on to those required minimum distributions and was not required to distribute that outright. If the trust had prohibited the accumulation of RBDs, like for example, the trust had said, trustee, you can accumulate all income but for the required minimum distributions, then the contingent beneficiaries would be disregarded. So we would not have to look at the 67-year-old life expectancy. Rather, we could have used, in this instance, the grandchildren's life expectancy. An accumulation trust, if that is the path that the family wants to go, it should only include contingent beneficiaries who are younger than the primary beneficiaries and may be prudent to obtain a private letter ruling before designating an accumulated trust as a beneficiary of retirement funds. Because obviously there's kind of 2 pieces of this. Is we want to make sure the trust will qualify as a designated beneficiary, but also 2, we want to, again, ensure that we use the life expectancies of the oldest primary beneficiary. Alternatively, because of these rules, many times if there's a sizable amount of assets within the IRA, it may be recommended rather to set up separate trusts for each individual beneficiary. There's some discussion of, well, in that case, you either would have the designated beneficiary set out specifically a third to Trust A, a third to Trust B, a third to Trust C. Additionally, there's been some discussion that, again, depending on what the amounts involved, you may in fact want to say, go take a step further and say, no, I'm going to have 3 separate IRAs, for example, and IRA 1, the designated beneficiary will be Trust A. IRA 2, the beneficiary will be beneficiary B. IRA 3 will be the beneficiary will be C, the Trust C. So, and the issue at the end of the day is that what we're trying to do is just to make sure that we can pay these tax-deferred dollars, incur income tax on those dollars, in a tax-effective way and a payout over time versus immediate taxation under the 5-year rule. So in summary, a trust can qualify as a designated beneficiary. So if there's concern within the family that they don't want these dollars to automatically go out right to an individual beneficiary, a trust can be structured that way. As a designated beneficiary, the trustee can distribute required minimum distributions annually over life expectancy of trust beneficiary or beneficiary. So if you qualify as a designated beneficiary, as we've discussed, then you're going to have the ability to pay that over life expectancies. Keep in mind, if we have a conduit trust, it's clear, the IRS has made it clear, we can make that income distribution or make those required minimum distributions annually with the oldest trust beneficiary's life expectancy. If we have a accumulated trust, accumulation trust, meaning that trustee can hold on to those required minimum distributions, then it becomes important to take a look at how that is drafted. Do we have older contingent beneficiaries than the primary? Which life expectancies would the IRS require us to use as far as calculating the required minimum distributions? So while a trust as a designated beneficiary is of value, we need to be clear how that's structured to maximize that annual payout. If it's not a designated beneficiary, the IRA has no beneficiary, and again, we're subject to the 5-year rule. And that's also important to note when we're dealing with IRAs and qualified retirement accounts as well, is that we always think in terms of the primary beneficiary, because sometimes you will see, and that's where many times people will, for sure, we have the spouse as the primary beneficiary. Spouse has many more options than other individuals. But many times people will not consider what is the contingent beneficiary because but the problem becomes if you designated a primary and don't have a contingent, again, we're dealing with a 5-year rule. And again, the other planning opportunity is maybe I want an individual. I'm okay with my child being named as beneficiary. You might want to consider if that child predeceases me, then I do want a trust created for my grandchildren. So at the end of the day, when we're dealing with designated beneficiaries, it becomes very important, and that's a defined term, that is completed and is part of your IRA so you can continue